Aha! I think you can hear me now. Testing, 1, 2, 3, testing. Can you hear me? If you can hear me now, say yes. Let's see. I think you can hear me now. I see my microphone. Can't hear me. 1 second. No sound. 1 second. Let me see. Testing, 1, 2, 3. Okay, everyone is now telling me sound is good. Okay, sound, type in here, sound is good. Okay, wonderful. Thank you everyone for all of this feedback. I guess you didn't hear the music I had playing earlier then, for those of you that were in the waiting room. You know, it was the most rudimentary issue. I just didn't turn on my mic, but that happens when you're away for a week in Asia. Okay, welcome everyone. I was asking everyone, let me know where you're tuning in from. I am so delighted to be back with all of you this morning. We had a very, very busy week last week. And I live traded it, all the big events, FOMC, Bank of Japan, with a number of traders in Bali. It was such a enriching experience for me and everyone there. And but I am so thrilled to be back here with all of you and to talk about some of what happened last week, and also talk about some of what could transpire this week. So, we had three really big events that happened last week. Number one, the Swiss National Bank was the first out of the gate to raise interest rates of the major central banks. Number two, we have the Bank of Japan raising interest rates for the very first time in 17 years. We also have the Federal Reserve basically confirming that they are basically going to look at 3 interest rate cuts in 2024. So all of you right now already have questions. You're looking at my heat map, and one of the main questions that you have is, why am I bullish the Swiss franc? Well, it's like a neutral bullish call, and we'll go through all of this. This is because I think we're going to see profit taking in the dollar this week because of a couple of things that we'll talk about. So it's more of a US dollar view than anything else, but I would say it's more neutral bullish. I am still bearish the Swiss francs against the euro, against the Australian dollar, but I think that it could rally against the US dollar. So maybe this should be at neutral. Maybe I'll edit it, but I wanted to have this on board so I could explain a little bit of it to you. Okay, so let's kick off and talk about the US dollar. So last week we had the Federal Reserve meeting, huge announcement, and everyone was focused on what they would say about the dot plot. And now we know that they still are looking for 3 interest rate cuts, 3 interest rate cuts this year, as opposed to 2. Sorry, let me just fix my camera. And welcome to Kathy's Caffeinated Market Buzz. So they think there's going to be 3 interest rate cuts this year instead of 2. And we did see a pullback in the dollar, but not by much. The dollar appeared after FOMC to recover a bit against the euro, against sterling, against some of the other major currencies. But I think, in particular, dollar yen is looking heavy for a variety of reasons. Because, first off, even though we had the FOMC rate decision and the Fed opted for slightly more dovish stance, favoring 3 interest rate cuts instead of 2. The idea is that we also had 2 other big developments over the weekend that are worth talking about. Number one, the Bank of Japan has stepped up verbal intervention, And the top currency official, Kanada, has talked about how he's not happy with the movements in the Japanese yen, and how maybe it's getting overextended. And so there's been more and more language related to verbal intervention. So that is something that it could be a bigger story this week in light of very little stories for the dollar and the yen. And also the People's Bank of China, previously, the People's Bank of China had basically maintained what many people believed was like a 7.2 cap on dollar yuan, and they kind of let that cap break or extend over the past week, and dollar yuan broke the 7.2 level. But over the weekend or on Sunday, they came back in and they ended up buying Chinese yuan and selling dollars. So the two actions by the Asia central banks could actually lead to a bit of weakness in the dollar and strength in the Japanese yen and strength in the Chinese yuan. So dollar yen, when we look at charts, you'll see is in my zip sell zone for the first time in 2 weeks. And so I think that we could finally see a bit of pullback in the dollar, but I'm still, just kind of neutral bearish dollars, because, we are seeing a little bit of risk aversion today. And euro and sterling, even though they're up today, had basically broken through a lot of support levels last week. So we do have to be careful because we have less data this week and we are below support zones. In general, I think that we'll see a bit of profit taking in the dollar this week. We don't have much in the way of economic data, but we do have to tread carefully, because since the FOMC meeting, we have mostly seen positive economic data out of the US. So data has been surprising to the upside, and there continues to be talk that we could still get 2 rate cuts this year instead of 3, even the dot plot. Seems like the market's not giving up on that idea. And part of the reason why they're not giving up on this idea is because this week we hear from Fed President Waller, who is one of the more hawkish members of the central bank. And Waller actually, believe it or not, has said that maybe they only need 1 rate cut this year, which would be, I think, is overly hawkish. And but Waller is expected, or potentially could be, the next nominee for Fed chairman. So that is something to be mindful of and to be careful of. All right, so that's basically the US dollar view, because the only meaningful data that we have is tomorrow. We've got consumer confidence and durable goods orders, but the main focus is going to be on Friday, when we have the personal income, personal spending numbers, and the PCE deflator, which is the Fed's preferred inflation measure. So it's really the back of the week that we have data, so we can see a little profit taking in the dollar in the front of the week, I think, since dollar may be doing catch up after the FOMC rate decision last week. In terms of the euro, we do have a few pieces of Eurozone data. On Wednesday, we have Eurozone sentiment numbers. On Thursday, we have German labor market numbers. And those figures are a bit of a tough call. Overall, it definitely seems like the Eurozone economy is stabilizing at a weak base. We have seen some upside improvements in data, but it is stabilizing at a weak base. The ECB is expected to lower interest rates in the summer, and there seems to be more and more language around that. But we are looking at the possibility of Wednesday's Eurozone sentiment numbers are just revisions, so that's going to be a non-event. And it's really just Thursday that we have German retail sales and labor market numbers. So once again, we could have a little bit of a rebound in the euro. Although overall, I think the Eurozone economy is definitely weaker than the US economy. And, that, could prevent meaningful gains in the euro. Sterling, on the other hand, is one of the strongest currencies this morning, but I'm bearish sterling because the Bank of England basically indicated that they are, they're looking at possibly lowering interest rates sooner. Now, the BOE is expected to be one of those central banks that is one of the expected to lower interest rates later than the ECB and the Fed. So they are expected to lower interest rates later. And the Bank of England statement that we had last week was a bit more dovish than the market anticipated, which is why pound crashed on Thursday. It is rebounding today because, as I said, profit taking in the dollar. But even with that, I think that sterling should underperform, particularly against the Japanese yen, against some of the other currencies like Aussie and Kiwi, and so I am bearish on pounds. Aussie, I am bullish because those Australian employment numbers last week was really good. Blowout Australian employment numbers. And, those numbers were really, kind of underscores the overall strength in the Australian labor market and in turn, the economy in general. And so, that is something that we can't dismiss because, those were very, very strong labor market numbers. The RBA did drop its tightening bias, which is still having just dropped their tightening bias, is still far less dovish than the BOE, the ECB, and the Fed. So I'm still comparatively bullish the Australian dollars. I'm also, comparatively bullish the Canadian dollar. And, let me just double check. I'm not sure if I think this heat map the tiles didn't update because it should actually say, maybe I didn't, it should actually say neutral. I think the colors are off. Let me just repost this. Sometimes the tile colors don't always come through perfectly. So let me see if it updates after I've shifted this or something is wrong with my back end. All right, there we go. So yes, we are now, and actually my Swiss franc was listed as bearish. So it's just some of the colors didn't come through. I think those were the only ones that didn't come through. So CAD, I'm actually neutral. I'm neutral CAD because of the weaker inflation data. The weaker inflation data is obviously a big story for Canada. And if you click on these tiles, you'll see that the BOC signals possible rate cut, but timing is unclear. Job reports beats, but IV falls to a 4-month low. CPI weakened and retail sales was negative. So that's why we're still bearish CAD on a comparative basis. Kiwi, I'm neutral because although we had a sharp rebound in the PMIs, the GDP numbers we had last week actually showed that New Zealand fell into a technical recession. Not a huge deal in my opinion because it is backwards looking and is a technical recession, but I think that this could resonate amongst traders for a bit longer. And so I'm comparatively bearish Kiwis. This one, should say bearish in the Swiss franc. I'm bullish Swiss francs against the dollar, but I'm bearish Swiss francs against the other major currencies because the SNB did come out the gate and was the first one to lower interest rates. And inflation hasn't been below 2% since July. So they are one of the most dovish central banks. And the yen itself also did not update, and I apologize for that. The yen is at neutral. I was doing all this while I was traveling, so I think it didn't save over. So I was on an airplane working on all this stuff, and I think the internet connection didn't pull over all this. So anyway, I'm neutral yen. I'm neutral bullish yen because obviously Japan raised interest rates for the first time since in 17 years, but they did try to downplay it. So I'm neutral bullish, probably a little bit more bullish than neutral. So that is basically my view on the heat map. On a data perspective, and And something that was really interesting, and I'll say this again, that came out of, talking to some of the experts that were trading alongside me in Bali, is that, someone made a really good point. Japan is very much a shame blame culture, which means that, they will do everything in their ability to not be shamed or blamed for any big actions. And so, having just raised interest rates for the first time since for the first time in 17 years, that basically is for many of the policymakers, an unprecedented move. And for many of the generations, they have not been traders, have not been around for a BOJ rate hike. So they're going to be very careful. They don't want to be blamed. UIDA definitely don't want to be blamed for causing a contraction in the economy, or for making mistakes, or for basically triggering a situation where they're back into a deflationary situation as a result of their rate hike. So that means that they're going to be slow with future rate hikes, much slower than the Fed may have been, or the ECB may have been, where they're going to be less willing to embark on an aggressive tightening cycle. And we're hearing that. And I thought that was a very good point, because the hedge fund trader that I was trading with was absolutely correct. They do come from a shame blame culture, and they don't want to be shamed or blamed for an economic turmoil that comes from a rate hike. So they're going to be very, very cautious and careful. And that is why I'm more neutral yen, but I'm neutral bullish. So taking a look at the economic calendar with the BOJ minutes yesterday, nothing revealing out of that. Today, no major economic reports. We had upward revisions to the building permits from the U.S., not a big deal. CBI distributive trade survey came in stronger, which is good for pound. This is a measure of consumer spending. Nothing going on during the U.S. session today outside of new home sales at 10 o'clock. And new home sales, I think, should be stronger. Just anecdotally from the U.S., the housing market has been stronger due to a lack of inventory. People are selling still, and so all of that is continuing to be positive for the U.S. economy. And then consumer confidence from the U.S. From Australia is due, and due to the hot labor market numbers, those should end up being a bit stronger. And then, as the week progresses, tomorrow we have durable goods orders in the U.S., which is always interesting. And durable goods orders are expected to rebound after a very ugly drop in January. House prices are expected to be stronger. As I said, the housing market in the U.S. remains firm, even though interest rates were rising because there was a lack of inventory. Consumer confidence, I think, should improve because the stock market has been on a tear, but we'll have to see. That is one of the most important pieces of U.S. data this week in light of less data. Then we have Westpac leading indicators and the business confidence, and that's very interesting, along with Australian. So these are for New Zealand. This is for Australian CPI. I hate that Daily FX got rid of the country code, because it's very hard to see the little dots, the little stars and the flags, and tell whether this is New Zealand, Australia, unless you hover on it. Anyway, I think that was a bad decision on their part. On Wednesday, we have revisions to Eurozone sentiment numbers, which are generally not a huge market mover, and nothing really from the US. We have Australian retail sales, which are expected to rise slightly less than the previous month, but still an improvement. Australian consumer inflation expectations, which are interesting, but according to the RBA, it seems like inflationary pressures have eased. On Thursday, we have German retail sales numbers, which are expected to rebound. And then we also have German labor market numbers, which are expected to hold steady. According to the PMIs, we had manufacturing report the fastest job growth since 2020, which should be good for the labor market numbers. But services, however, reported weaker job growth. So we'll have to see which way leans more strongly. But these numbers could be a bit firmer, which support the euro. As I said, it seems like Eurozone activity is stabilizing at a low base. And then we have Canadian GDP numbers. These are monthly figures, which is less market moving than the quarterly figures. But we did have stronger retail sales and stronger trade data. So these numbers could be a bit firmer. And the weekly jobless claims reports, always, interesting to watch these days. Chicago PMI, pending home sales, and then revisions to the University of Michigan index. Now, UMich survey is usually released on Friday, but Friday is a holiday this week in the US, Good Friday holiday. And first, this is interesting because we have Tokyo CPI being released on Good Friday. Good Friday is celebrated in Europe as well as the US. So European markets and US markets will be closed. That makes, Tokyo CPI even more important because there's less liquidity. And because, we did have that rate hike from the Bank of Japan, investors will be watching this number closely to see whether the data justifies another interest rate increase soon by the Bank of Japan. And it's actually Japanese data dump because we have the inflation data, the unemployment rate, industrial production, retail sales numbers. So, the yen could very much be on the move on Thursday evening, even though we have a holiday in the US. So Good Friday, many holiday, UK, US, Switzerland, Australia, Canada, Eurozone, all markets are pretty much closed on Friday. We do have the personal income, personal spending numbers, so it'll be less market moving because of the holiday. We also have Powell speaking, which could be interesting, but I don't think he's going to reveal anything new. I generally don't trade on holidays because of the less liquidity and the less participation. But we do have some interesting pieces of data. I don't advise you trading on holidays. It's always a bad idea when the markets are closed. So, just be mindful of that. In terms of the data, this is what I was saying. Dollar yen is in the ZEP sell zone for the first time since this period here. And we actually been below the indicator line since the 11th of March, 2 weeks ago. So I think it's a pretty big deal. I think that dollar yen could have a bit more room to fall on the downside. If you look at the daily chart, we're certainly rolling over. And I think that we could get to this congestion zone over here at 150.50 pretty easily. And so I think we could see a deeper pullback in the dollar. And, that corresponds with, a bit of a recovery in euro, although euro is a lot of resistance above. There's, all of the major moving averages above current levels. So it's going to struggle more than dollar yen. I think near term, dollar yen could be, a very interesting trade. Pound dollar bounced right off of the 200 SMA. No coincidence here. Moving averages are important, and there's resistance up around here, 126.75 to 127. I think that's where it could extend. Pound does look like there's more room to extend than euro. Talked about dollar yen already. I think it could come to this down to this congestion zone here around 150.50. Dollar Swiss. This is a reversal candle. I think that it's struggling to drop. I think that it should drop. I think that it should drop to this region here, former resistance turn support, right around this region here. I would say right around 89 is where I think dollar Swiss is going to pull down to. Aussie dollar is rebounding, but also a lot of resistance above current levels. So definitely keep an eye out for that. That is something that we could definitely see, a bit of a rally towards, and definitely something that we want to keep an eye on. I am more bullish Aussies than the other currency pairs, and but it really needs to get above 65.60. So definitely, keep an eye out for that because that's where resistance is. If we get above 65.60, then it would move more room to the upside. But I think Aussie is more a story against the crosses than against the dollar. Kiwi, on the other hand, is deeply oversold. A very lackluster bounce today. And, there is more room for a bounce. But as I said, those New Zealand GDP numbers did come in weak. And that's preventing Kiwi from really participating in the rally. Dollar CAD. Also relatively shallow recovery in the CAD today. Oil prices are up a little bit. Oil prices have been nice. They've been at $81. I think the dollar CAD could slip down to 135.50, but I think the uptrend remains intact. So many of you pointed to Swiss yen as a nice trade idea because we're bearish Swiss francs, bullish Japanese yen. And yes, I do think Swiss franc is a nice trade idea. I think there's a very good chance we could slip down to these lows here around 167.50, which is a nice room for a move. It's about almost 100 pips. So I like this move quite a bit, and I like the way it's trading right now. All right, any questions? Boris is going to talk about gold. I know many of you are interested in gold, as well as indices. A lot of you trade indices as well, particularly those of you that are asking about stocks. We do trade stock indices. Boris will share his thoughts on that. We already talked about the Swiss franc, Swiss yen. I do like that quite a bit. And so why did the yen go down even after the rate hike? Because the Bank of Japan downplayed it. They downplayed the move, but I think that it's unavoidable. I think that we're going to see weakness in the Japanese pairs like dollar yen and Swiss yen. Do you want to take the screen, Boris? I cannot hear Boris.
Sorry, no. I was on mute. I was on mute. Sorry, I'm off mute. Hi guys. Good morning. Good morning. Good morning. I sound a little bit like a frog today because my daughter gave me a cold, so my apologies for that. Give me just 1 second. I'm going to grab the screen from Kathy. And just 1 second. Let me make sure I get the right screen. Okay. All right. Awesome. You should be able to see my my gold screen, and that is indeed the most interesting chart, I think, of all the instruments. I'm getting constant requests about gold, gold signals. Just to let you guys know, we've developed a whole bunch of really good medium-term gold signals and short-term gold signals, including like intraday gold signals that I'll be releasing in the room in the near term. So if you're interested, absolutely come join us at BK. There's going to be a whole bunch of interesting gold trading activity that we're going to be doing. I'm very actually pleased with the quality of these signals. Right now, what I'm showing you is actually the intermediate term, kind of longer term, 1 hour type of gold signals. And I think when you're looking at the gold chart, it's just incontrovertible at how bullish it is. This is all signals to the bullish side. We're not even taking, as a matter of fact, my whole thesis on gold for the time being, until until the whole thesis changes, is that there's really only two positions in gold. You're either long or you're flat. This is not a time to trade gold to the short side. When gold retreats into its corrective mode, you can step back, or if you want to, you could trade it on an ultra short term basis, on a scalp basis to the short side. But generally, the far better strategy, the absolutely great strategy since the start of the year, and really since November of last year, since Thanksgiving, has been just to do one thing, which is either get long when long signals start popping up on the charts, and then stand flat when it goes into its corrective periods. So the question right now is, where are we on the move? I think it's way too early to say that it's in a corrective period. We've taken out the 2,200 point level, which is the highest high we've had nominally in the history of gold, and we're holding it. We're holding really quite nicely. And I really, honestly, at this point, you sort of have to think that unless gold drops below 2,000, which is a very psychologically important level, it's really just right now in a consolidative phase to move higher. And that's fascinating because it's really moving up against a relatively strong dollar, against very strong yields on the U.S. side that are not really budging down, against an inflationary background that seems relatively persistent. And I think it's really, I no longer even try to speculate on the fundamental side, because I think it's impossible to really find out what the fundamental driver is. Gold is really not a fundamental driver, it's a sentimental driver. But I think if you were going to look at the sentimental drivers, it's clear to me that what the market is really concerned about is the fiscal health across all of OECD, but especially, of course, across the US fiscal conditions, simply because we're running very large deficits. We're certainly able to finance them now, but it's actually more toxic than that. The fact that a huge part of the deficit is actually being consumed by interest rate payments. I believe that sort of like the top three items in the U.S. budget are Social Security, defense, and interest rate payments, which means that really, all of the money that is being raised out of tax revenue, fully a third of it is just being dedicated to just servicing the debt, which is why, by the way, I think the Fed is so dovish, despite a very, very vibrant and really no reason to cut rates economic background. We're certainly nowhere near Fed's inflationary target. We still have lots and lots of service inflation built into the system, and the economic data continues to surprise to the upside. So all of this, I think, is an interesting cauldron of factors. The most important thing is gold keeps going up, and I think that's really the only thing you need to focus on. And it's just a matter of catching those signals when they appear on the charts. Right now we're flat, as you can see. The market doesn't have any long, intermediate term signals for us, but there certainly are shorter term signals that we're going to be trading, and I think that's very, very interesting. In many ways, also, the key thing to watch here, a gentleman who I respect very much, was used to be a big analyst at Lehman Brothers, said something super interesting. He said that the Fed doesn't determine interest rates, oil determines interest rates. I think that's probably the truest statement I've heard anybody say in a very long time, because if you think about this, if you really actually look at what correlates to interest rates, it's the rise in oil prices. It makes sense because oil drives inflation, inflation drives interest rates. That's really the underlying factor. So oil to me is an interesting look. We're holding 81. We are in what I would call a comfort zone. But if oil starts to creep to 90, that absolutely means we're going to have higher inflation, higher and longer interest pressure on the interest rates, perhaps even a greater stress on the budgetary constraints, and pushing gold up, right? I think the argument here is that that interest rates are a competitor to gold is losing steam every single day. It used to be very true. Higher interest rates that would create a massive corrective move in gold, but now gold is not trading on that. It doesn't care that it's not competitive on the interest rate front. It's really trading much more on sovereign debt front. I think that's the big theme to be looking at as the year goes forward. So all of these pieces in the puzzle, oil, interest rates, gold, are going to be a key focus for us as we go forward. As far as equities go, they still continue to be moving up in a very slow but steady fashion. Again, not a trade to the short side. Equities are either long or flat trade. And right now we're also kind of flat equities. They've actually turned bearish on the 1 hour chart, so we are standing down on our intermediate term intraday signals, but we'll be trading all of them on a scalp basis continuously. So if you're interested, absolutely come join us. All of these signals are fully automated and fully systematized. So there's really they're great because they offer you very clear, precise quantitative entries at all of these places. So that's pretty much it. I got to stop talking because otherwise I'm just going to choke on myself here today. My apologies. I will see everybody live trading in exactly 10 minutes. And I hope to see everybody in BK. Hope you guys really enjoy it. But the sort of interesting point for all of you guys going forward is gold is going to be a massive focus both in the markets and within BK. So if you're interested, certainly come join with us. We're going to be talking about that a lot.
I absolutely agree. Gold is a huge story this year, Boris, and I think that it's just at the beginning of what could be a really big move. There's plenty of trading opportunities there. So definitely check us out at bktraders.com. And for those of you that are complaining about the password to the heat map, this is actually supposed to be for members only. And, it was, we had been having a glitch beforehand. It was offered, publicly, but that's been fixed. We have a lot of fundamental tools for our traders. The heat map is one of those, and something that, we value quite a bit. And I'm glad you found it helpful in the past. Otherwise, we will talk to you again, and have a great day, trading week. And BK members, we're live streaming every day with you, so we will talk to you tomorrow.
Yeah, we'll see you guys in the markets. Everybody have a wonderful time. Bye-bye.